Hey, my name is Julia Brown. I am a Scotsman Guide loan officer for the year 2020, and I'm here to talk to you about what's going on in the housing industry as of March 2021. And it is a crazy time right now for mortgages, for refinances, for home purchases, everything in between. So let's get into it. I never do this, but I actually made note cards for today because there is so much going on in our industry. The first thing I want to talk about is buying right now. I've talked to individuals, friends, and colleagues who are loan officers, realtors, attorneys, builders, appraisers, inspectors, all over the country. And what we're seeing is what is scarce is valuable. So if you are a seller, yes, everywhere it is a seller's market. You can basically write the terms that you're looking for and you'll get 15 offers, pretty much all equally well qualified, plus about 30 more or so that are, maybe in your slush pile. So yes, if you are a seller, you are, positioned greatly to be able to make a good buck on selling your home. If you are a buyer, don't get discouraged. You're not out. There are just some factors playing a role in what's available to you and what it's going to take to write a winning contract. So the first thing I want to talk about is why is housing so scarce right now, right? So what's going on? What's driving this? Well, the cost of rent has been up and up and up and up here over the last few years. And so renting has become less affordable. Meanwhile, rates are super low and, people have, relatively speaking, we're in a position of economic recovery. So people have good jobs. They're starting to save sooner. They're starting to pay off debts sooner. They're poised to be able to purchase. But not a lot of people are selling, or the people who are selling are also buying. And so there's a lot of competition in the market still. In addition to this, what we're finding is that investors who are doing short-term vacation rentals like VRBO or Airbnb are coming into the market and gobbling up some of the homes and condos that like first-time home buyers would historically have taken for themselves. Also, investors who do long-term rentals, so we're talking about 12-month leases, 24-month leases, etc., are coming into those same markets, holding their properties longer, acquiring more in their portfolio. And I think a part of this is due to the fact that through coronavirus and its impact, we've seen a bigger gap between middle class and upper class. So it's kind of the people who are, maybe it used to be level playing field. These individuals are getting harder hit, where these individuals are having more opportunity to capitalize on the changes. So for the investors coming into the market, where investors who are existing in the market today, they're gobbling up more properties, they're able to put a higher percentage down, and so their offers are looking stronger to a listing agent and to a seller. And in addition to that, what we're seeing is they have more cash flow, so it's easier for them to write in what's called an appraisal gap and to validate proof of funds. An appraisal gap is when essentially we say, hey, even if the house doesn't appraise for this amount, we're willing to pay X amount of the difference. And oftentimes even, right now we're seeing a full appraisal gap, meaning my husband is a realtor, Bob Brown with Keller Williams, and he's got a client who wrote an offer on a house that was listed at $235,000 for $270,000. Now their expectation was that the house would come in somewhere between $255,000 and $260,000, and he knew full well that even if it came in at $235,000, he would have to have cash on hand to cover the difference, right? So some people can do this, but many cannot, especially first-time home buyers. If you are someone who's selling a home and you're gonna get a lot of equity out of the sale of your house, you can roll that into the new loan. And so it's easier for you to be in a position to write an appraisal gap in. Or if you're an investor or a group of investors, a partnership, you've likely got a lot more capital than our standard first-time home buyers. So that makes it a little bit tougher for first-time home buyers all over the country right now. And something that Fannie Mae and Freddie Mac have done recently, just Monday of this week, is they've put in a pricing adjustment for second homes and investment properties, because the philosophy driving those GSEs is that, first-time home buyers or homeownership should be a realistic, attainable American dream for individuals. For primary residences, right? So the intention has always been like primary residences should come first or have priority here. So second homes and investment properties just got a bit more expensive, right? So if the interest rates on the second homes and the investment properties are more expensive now, that will give first-time homebuyers an opportunity to stay competitive in today's market. Because rates are so stinking low, that's not to say it's really going to deter too many people, but it is something that Fannie and Freddie are doing to help keep our first-time homebuyers or people who are buying primary residences in the mix when it comes to putting offers in on homes. So outside of the appraisal gaps, and outside of the impact that we've seen from short-term vacation rentals or, the long-term rentals and the impact of very high rents, there are a couple other things at play here today in the mortgage industry. So I think something else we've seen is that employers have found, yes, there is an ability to work remote and work from home, and it doesn't impact, most industries' productivity. So there's more of an allowance of this work from home. So you've got a lot of people who are in coastal cities that are extremely expensive to live in, moving to the heartland, moving to the Midwest, moving to more rural areas where they can go from having, a 3-bed, 2-bath, 1,000-foot ranch for $1 million to a 6-bed, 5-bath on 3-acre, little mini McMansion in, Columbus, Ohio, for example, for the same $1 million. And so that's become really appealing to a certain group of people. Now, again, they're going to have more cash flow if they're selling a house that they have in, say, California or Chicago, right? And they're getting a ton of money there. They've got a lot of capital where they can come into these markets. And we're also seeing a strong influx of technology coming more into the center of the country as well. Now, with that said, people I want to be, paying attention to this especially are, if you're looking at higher priced homes, you've got some people who are very well paid individuals or business owners who are moving strategically into states that have 0 state income tax. So if you're in Tennessee or you're in Florida or you're in Texas, you're probably seeing a huge influx of people with a lot of capital, again, who are moving strategically to not have to pay into state taxes. I have a very close friend of mine in Nashville, Tennessee, who went to a builder yesterday to ask the builder, hey, what's our timeline for a new build? She was going into it thinking like, at least there won't be competition. I'll know what the price is. I'll know when we can start. I know when the construction will be over. And so I'm not competing with as many people. And the builder laughed and said, we have a wait list of 40 families for next year's builds that will be done at the end of next year. So it's really a matter of, just scarcity. Again, I'm going to go back to that. What is scarce is valuable. And right now, housing is scarce. Again, I'm not saying this to deter you. I just want to set realistic expectations about what's happening right now, what trends we're seeing, or what things are popping up. I think, besides the transplants that we're getting in certain areas, and besides the ability to work remotely, another driving factor here is you have a group of millennials and even Gen Z that are starting to get interested in home ownership and not just renting. And as rents continue to rise, are seeing the value of that home ownership, right? So that's something that you're seeing come into play as well here. Now, there is kind of this philosophy that I'm hearing of like, let's wait for another collapse, or we're on the verge of another collapse. So I want to address what's different today than in 2008 when we had our last collapse. So the last time that this happened, the collapse was driven by less than diligent underwriting, right? So we had people who were doing stated income or stated assets, right? Like, hey, I make this much. Oh, okay, sure. Here's your house, right? They weren't putting very much money down. There were options to put no money down, a lot of options to put no money down. And so you had people who probably were over leveraged and didn't have any skin in the game. And so it took the smallest little move in the market for things to go wrong and for people to end up defaulting on their mortgages and going into foreclosure. Now, our underwriting guidelines are much stricter today than they were in 2008. I mean, we are talking ability to repay is very, very well documented across income, assets, and credit. I would say in the last 10 years that I've been doing this, we've seen fewer and fewer individuals with sub 580 or sub 620 FICO scores getting into homes. And when they are, they're taking loan program types that oftentimes require homeownership counseling and homeownership education. So from that perspective, the bubble piece, I don't believe that we are going to see anywhere near the same degree of foreclosures or loss in home values, because I don't think we're gonna have those same issues. People are well aware and well informed of what they're getting into at the time that they make their purchase today. And our underwriting staff, our compliance staff, the auditors within the agencies are all checking and testing to make sure we're meeting new federal regulations that did not exist in 2008. So from that perspective, I don't believe we're at risk for a bubble. Where I think we, maybe have a bubble on values is because of the scarcity position that we're in now. Once some builders get caught up, once people start to age into, maybe more people start to downsize and we get through this wave, then level off. Our values might level off or drop a little, right? But buyer fatigue might be driving that more than anything, right? There's buyers out there have been looking for 6 months. They say, you know what, let's sign a new 1-year lease and we'll look again next year, right? So that might drive things more than any other factor. But again, what we're seeing is we are in a position of economic recovery. We're not in a backsliding position where we're about to collapse, at least from what I'm hearing and what I'm seeing. So I think that that's something to be aware of. If you have this idea like, hey, I'm just going to wait for everything to fall apart, just remember that the housing industry is a really big component of the economy as a whole. So if the housing industry falls apart, other things may fall apart as well. So if you qualify now, you like something now, knowing how great the rates are, I don't see a reason to wait. Personally, if the housing industry collapses in and of itself, I'm screwed. I would not be eligible for anything. So if I saw something that I liked now, even if I'm going to pay a little bit more for it than I would have 5 years ago, or I might in 5 years, I want to make hay while the sun is shining, right? So that's something that I always keep in mind is smoke them while you got them, right? If you are qualified now and it works for you now, just go ahead and do it. Don't wait for something that is not a guarantee or a sure thing. Or if it does happen, could have really negative impacts on you individually where it makes financing impossible for you. Let's see, what else? Is there anything else that really needs to be covered? I'm gonna just look here at my little notes. Oh, rates. So all of a sudden I'm getting these new set of expectations that people have about what rates should be. No, you're not going to get a 30-year fixed in the ones. I'm sorry, that's not a thing. There was a moment in time where rates probably dipped to an unsustainably low position earlier in the year and at the end of last year. Now, I don't have a crystal ball. I don't set the rates. I don't know what's going to happen, but there is a lot of pressure on the agencies and on the government to keep things low so that everything stays sustainable and things stay moving. Now, with that said, and taking that into account, we are talking about people's expectations going from 4.25 on a 30-year fixed 8 years ago to now I say 3.125 on a 30-year fixed, and people bristle oh, that seems high. It's all relative, right? It's whatever the norm is at the time. And so we got into a position where the norm temporarily was just incredibly, incredibly low. And even to say a 3.125 on a 30-year fixed out loud, for me, somebody who's been doing this for a very long time, feels like, can that be right? Am I quoting a 20-year? Is that a 15? Because it is just so cheap. It's such cheap money, and you have access to it, and you have access to it today. So rates are still really good. If you're looking to refinance, I've had people say, oh, I'm at a 4.625, but I really missed my opportunity. No, not necessarily. Everybody's got a different value of a dollar, right? So it's worth having a conversation and really analyzing what your goals are, right? If you want to shorten your term or take cash out of the equity that you have, or if you want to just lower your payments as much as possible, depending on how long you've been in your current home, you might have the equity to do all or any of those things. So talk to somebody. If you're interested, don't just write it off as I missed my opportunity until you've had an opportunity to talk to somebody who's professional and really is an expert in the field. We're all more than happy to help. I guarantee it. So with all that said, that's what's happening around mortgages in 2021 so far. It is the end of the first quarter, and I'm really looking forward to hearing what you've got to say. So if you have any comments, questions, please post them down below. My 5-year-old told me to say, smash that like button. So I feel so embarrassed just having said that. But like, subscribe, comment below, and share with friends. Thanks. Have a great one.